Listen, something extraordinary is happening in the silver market right now. And if you're not paying attention, you're missing one of the most significant price movements we've seen in years. I'm talking about silver trading around $30 per ounce as of January 2025. But here's what most people don't understand. This isn't just another price fluctuation. This is the market responding to a perfect storm of global events that are converging at this exact moment. Let me paint you a picture of what's actually happening behind the scenes, because the mainstream financial media isn't telling you the full story. They'll give you the surface-level analysis, maybe mention that silver is up or down a few percentage points, but they're completely missing the deeper forces at play here. And those forces? They're the same ones that drove silver from $4 an ounce in 2001 to nearly $50 in 2011. Except this time, the fundamentals are even more compelling. Right now, as I'm speaking to you, the global silver market is facing its most severe supply deficit in modern history. The Silver Institute just released their forecast for 2025, and they're projecting a massive deficit that's going to persist throughout the year. We're not talking about a small imbalance here. We're talking about industrial demand, investment demand, and jewelry demand, all competing for a shrinking pool of available silver. And when you have more buyers than sellers, when you have more demand than supply, there's only one direction prices can go. But here's where it gets really interesting. The US dollar has been strengthening recently, and traditionally, that puts pressure on precious metals prices because they're denominated in dollars. So when the dollar goes up, metals typically go down. Except silver isn't following that script right now. Despite dollar strength, silver is holding remarkably firm around the $30 level. Do you know what that tells me? It tells me that the underlying demand is so strong, so persistent, that it's overriding one of the most powerful inverse correlations in the commodities market. Think about what that means for a moment. Imagine you're trying to push a beach ball underwater, but it keeps popping back up to the surface. That's what's happening with silver right now. The dollar is trying to push it down, but the fundamental demand, the real, physical demand from industries, from investors, from central banks, is so powerful that it's keeping prices elevated despite the headwinds. Now let's talk about what's driving this demand, because this is where the global events piece comes into play. First, you've got the industrial side of the equation. Silver isn't just a precious metal, it's an industrial metal. It's the most conductive element on Earth. Every solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. Every 5G tower, every smartphone, every computer chip, they all need silver. And as the world transitions to green energy, as electric vehicle adoption accelerates, as technology becomes more sophisticated, the industrial demand for silver is exploding. The solar industry alone is projected to consume over 200 million ounces of silver annually by 2025. That's nearly 20% of total global silver supply going to just one industry. And that demand isn't optional. You can't build a solar panel without silver. There's no substitute that works as well. So as governments around the world push for renewable energy, as companies commit to net zero emissions, they're essentially committing to consuming massive amounts of silver, and they have no choice but to pay whatever price the market demands. But industrial demand is just one piece of the puzzle. Let's talk about what's happening in the investment world, because this is where things get really fascinating. You see, silver has always been viewed as gold's little brother, the poor man's gold, if you will. But that perception is changing rapidly. Investors are waking up to the fact that silver offers something gold doesn't. It's both a monetary metal and an industrial metal. It has dual demand drivers. And in an environment where inflation is still a concern, where currency debasement is ongoing, where geopolitical tensions are rising, silver offers a unique value proposition. Look at what happened during the Federal Reserve's easing cycles historically. Since 1981, silver has risen in 6 out of 7 easing cycles, with an average gain of nearly 17%. We're in an easing environment right now. The Fed has been cutting rates, and while they might pause or adjust their trajectory, the overall trend is toward easier monetary policy. That's historically been rocket fuel for silver prices. And we're seeing that pattern play out again in real time. But here's what really keeps me up at night, and what should have your attention: the paper silver market versus the physical silver market. This is the story that nobody's talking about, but it's absolutely critical to understanding where prices are headed. You see, the vast majority of silver trading happens on exchanges like the COMEX, where contracts are traded that represent silver, but very little physical metal actually changes hands. It's paper silver, promises to deliver silver at some point in the future. The problem is, there's far more paper silver being traded than there is physical silver available to back those contracts. It's like a bank that's issued more deposit receipts than it has cash in the vault. As long as everyone doesn't show up at the same time demanding their money, the system works. But what happens when people start demanding physical delivery? What happens when industrial users, when investors, when institutions start saying, I don't want a contract, I want the actual metal? We're starting to see signs of stress in that system right now. Premiums for physical silver, the amount you pay above the spot price to actually get your hands on real metal, have been elevated. Delivery times have been extending. Dealers are reporting supply constraints. These are all warning signs that the paper market and the physical market are starting to diverge. And when that divergence becomes too great, when the fiction of unlimited paper silver collides with the reality of limited physical silver, prices have to adjust dramatically. Let me give you a historical parallel that might help you understand the magnitude of what we're potentially facing. In 1980, silver hit $50 an ounce. Now, most people know that story. The Hunt brothers tried to corner the market, prices spiked, then crashed. But here's what's different about today. In 1980, that price spike was driven by speculation and manipulation. Today, we're looking at genuine fundamental supply and demand imbalances. We're looking at structural deficits that can't be resolved quickly. We're looking at industrial demand that's non-negotiable. If you adjust that 1980 peak for inflation, silver would need to reach over $180 per ounce in today's dollars to match that high. Now, I'm not predicting we'll see $180 silver tomorrow, but I am saying that the current price around $30 doesn't reflect the true supply-demand dynamics in this market. It doesn't reflect the industrial demand growth. It doesn't reflect the investment demand that's building. And it certainly doesn't reflect the geopolitical factors that are driving countries to diversify away from dollar-denominated assets. Speaking of geopolitical factors, let's talk about what's happening on the global stage right now, because this is where the global events part of our title really comes into focus. You've got de-dollarization accelerating. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to reduce their dependence on the US dollar for international trade. They're settling transactions in their own currencies. They're building alternative payment systems, and they're accumulating precious metals as reserve assets. China has been on a gold buying spree, adding to their reserves month after month. But here's what's interesting. China is also the world's largest silver producer and one of the largest silver consumers. They understand the strategic importance of silver better than almost anyone, and they're not exporting as much as they used to. They're keeping more of their production for domestic use. That's reducing global supply even further, tightening the market even more. Then you've got the situation in Russia. Sanctions have pushed Russia to rely more heavily on precious metals for international trade. They're using gold and silver to settle transactions with countries that are willing to trade with them outside the dollar system. This isn't speculation. This is documented reality, and it's creating additional demand for physical metal that didn't exist a few years ago. Now, let me address something that's probably on your mind. Volatility. Yes, silver is volatile. It can swing 5% in a day. It can drop 20% in a month. That volatility scares a lot of people away. But here's what you need to understand. Volatility works both ways. The same characteristics that allow silver to drop quickly also allow it to rise explosively. And when silver moves, it moves fast. We saw this in 2020 when silver went from $12 to $30 in just a few months. We saw it in 2011 when it went from $18 to $48 in less than a year. The key is understanding that volatility is the price you pay for the potential upside. If you want a completely stable, predictable investment, you buy treasury bonds and accept minimal returns. If you want the potential for significant gains, you accept some volatility along the way. And right now, with all the factors we've discussed aligning, the risk-reward profile for silver looks extremely attractive. Let me shift gears for a moment and talk about something that's relevant if you're thinking about your long-term financial security. If you're sitting on $100,000 or more in retirement accounts, 401ks, IRAs, that kind of thing, you might want to know that there are ways to get physical precious metals into those accounts without triggering tax penalties. I put together a free guide that explains how gold IRAs work, how you can diversify your retirement savings with physical metals while maintaining the tax advantages. It's in the description below, if that's something you want to explore. No pressure, just information that might be useful for your situation. All right, back to the market dynamics, because there's another layer to this story that's absolutely crucial. Let's talk about the silver to gold ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1. Right now, with gold trading around $4,100 and silver around $30, We're looking at a ratio of roughly 137 to 1. That means silver is historically cheap relative to gold. Now, some people will argue that the ratio doesn't matter, that silver and gold are different markets with different dynamics, and they're partially right. They are different markets. But history shows us that when this ratio gets extremely stretched, it tends to revert to the mean. And the way it reverts is usually through silver outperforming gold. We saw this in 2011 when the ratio compressed from over 80 to 1 down to 32 to 1 in just a few years. Silver didn't just keep pace with gold, it massively outperformed. Could we see that kind of compression again? Absolutely. In fact, given the industrial demand factors we've discussed, given the supply constraints, given the investment demand that's building, I'd argue the case for ratio compression is stronger now than it was in 2011. And if that happens, if we see the ratio move from 137 to 1 down to even 80 to 1, that would imply a silver price of over $50 per ounce, assuming gold stays where it is. If gold continues rising, which many analysts expect, silver could go even higher. But let's get more specific about the supply situation, because this is where the rubber really meets the road. Global silver mine production has been essentially flat for years. We're not discovering major new silver deposits. The existing mines are getting deeper, more expensive to operate, and producing lower-grade ore. Meanwhile, demand is growing across every category: industrial, investment, jewelry. You don't need to be an economist to understand what happens when supply is flat and demand is rising. The Silver Institute's forecast of a continued deficit in 2025 isn't just a prediction, it's a mathematical certainty based on current trends. Industrial demand alone is projected to exceed 550 million ounces. Investment demand could add another 200 million ounces. Jewelry and silverware demand adds more on top of that. And total global production? Around 830 million ounces. The math doesn't work. There's not enough silver being produced to meet all the demand. So where does the extra supply come from? Recycling, primarily. But recycled silver has limitations. You can't recycle silver that's been used in solar panels. It's too dispersed, too expensive to recover. You can't easily recycle silver from electronics. The bulk of recycled silver comes from jewelry and silverware, and that supply is relatively inelastic. It doesn't respond quickly to price changes. This means the market has to ration demand through price. If there's not enough silver to go around at $30 per ounce, the price has to rise until some buyers are priced out of the market. That's basic economics. And given that industrial users have no choice but to buy silver, they can't build solar panels or electric vehicles without it, they'll pay higher prices, which means investment buyers and jewelry buyers are the ones who get priced out. But as prices rise, that attracts more investment demand, not less, because investors see the momentum and want to participate. It's a self-reinforcing cycle. Higher prices attract investment demand. Investment demand tightens supply further. Tighter supply pushes prices higher. And round we go. We saw this exact pattern play out in 2010 to 2011, and we're seeing the early stages of it now. Now, let's talk about the elephant in the room. Central bank policy. The Federal Reserve, the European Central Bank, the Bank of Japan. They've all been engaged in unprecedented monetary expansion over the past 15 years. They've printed trillions of dollars, euros, yen. They've kept interest rates artificially low. They've distorted markets in ways we're still trying to understand. And while they've been trying to normalize policy recently, trying to raise rates and reduce their balance sheets, the fundamental reality hasn't changed. There's far more currency in circulation than there was a decade ago. What does that mean for silver? It means that the purchasing power of fiat currencies is declining over time. It means that hard assets, things with intrinsic value, things that can't be printed, become more valuable in nominal terms. Silver is one of those hard assets. It's been money for thousands of years. It's been a store of value across civilizations. And in an era of currency debasement, it's a hedge against the loss of purchasing power. But here's what makes silver particularly interesting compared to gold. It's more accessible. At $30 per ounce, you can buy a meaningful amount of silver with a few $1,000s. Gold at $4,100 per ounce requires significantly more capital. For the average investor, for someone who wants to own physical precious metals but doesn't have tens of thousands of dollars to deploy, silver is the practical choice. And that accessibility creates a broader base of potential buyers, which supports demand. Let me share a story that illustrates what's happening in the physical market right now. I was talking to a dealer recently, someone who's been in the business for 30 years. He told me that in the past 6 months, he's seen a fundamental shift in his customer base. It used to be mostly older investors, people who remembered the inflation of the 1970s, people who were naturally skeptical of government and central banks. But now he's seeing younger buyers, millennials, Gen Z, people who've never owned precious metals before but who are concerned about inflation, about currency debasement, about the stability of the financial system. These new buyers aren't speculators. They're not trying to flip silver for a quick profit. They're buying physical metal and putting it away for the long term. They're treating it as insurance, as a hedge, as a store of value. And that kind of demand is sticky. It doesn't disappear when prices dip. In fact, it often increases when prices dip because buyers see it as an opportunity to accumulate more at better prices. This is creating a floor under the silver market. Every time prices pull back, new buyers step in. Every time there's a correction, physical demand absorbs the selling pressure. And that's making it harder and harder for prices to go down, while making it easier and easier for prices to go up. Now let's talk about the technical picture because the charts are telling an interesting story right now. Silver has been consolidating around the $30 level, building a base. In technical analysis terms, this kind of consolidation after a significant move is often a sign of accumulation. It's the market digesting gains, shaking out weak hands, and preparing for the next leg higher. We saw similar patterns before major breakouts in 2010, in 2016, in 2020. Each time silver consolidated, built a base, then exploded higher. The key level to watch is $32. If silver can break above $32 and hold it, that opens the door to a move toward $35, then $40. And once we get above $40, we're in uncharted territory for this cycle. We're talking about potential moves to $50 and beyond. The technical setup is there. The fundamental backdrop supports it. The only question is timing. But here's what you need to understand about timing in the silver market. You can't predict it with precision. You can't say, silver will hit $40 on March 15th at 2:30 p.m. Markets don't work that way. What you can do is recognize when the conditions are favorable, when the odds are in your favor, and position yourself accordingly. And right now, the conditions are about as favorable as I've seen them in years. Think about it this way. If you're waiting for absolute certainty, for a guarantee that silver will go up, you'll never buy. By the time something is certain, by the time everyone agrees it's going higher, the easy money has already been made. The opportunity is now, when there's still skepticism, when there's still debate, when prices haven't yet reflected the fundamental reality. Let me address another concern that people often raise. What if the economy goes into recession? Won't that hurt silver demand? It's a fair question, and the answer is nuanced. Yes, a severe recession would likely impact industrial demand for silver. But it would also likely trigger more aggressive monetary easing from central banks, which would be bullish for precious metals. And historically, silver has performed well during periods of economic uncertainty, because investors seek safe havens. Moreover, the industrial demand for silver isn't as cyclical as it used to be. The growth in solar energy, in electric vehicles, in 5G infrastructure, these are long-term trends that continue regardless of short-term economic fluctuations. A recession might slow the pace of growth, but it won't reverse the trend. And on the investment side, economic uncertainty often drives more demand for precious metals, not less. So even in a recession scenario, the case for silver remains intact. In fact, you could argue it becomes stronger because the policy response to recession, more money printing, lower interest rates, fiscal stimulus, all of those things are bullish for hard assets like silver. Now, I want to talk about something that doesn't get enough attention: the energy cost of producing silver. Mining is an energy-intensive business. You need diesel fuel for the trucks, electricity for the processing equipment, natural gas for the smelting, and energy costs have been rising. This puts upward pressure on the cost of production for silver miners, and when production costs rise, miners need higher prices to maintain profitability. This creates a floor under silver prices, a level below which production becomes uneconomical. We're seeing some mines already operating at marginal profitability at current prices. If silver were to drop significantly from here, some production would come offline. That would tighten supply even further, which would support prices. It's a self-balancing mechanism, but it works with a lag. And in the meantime, the deficit persists, inventories draw down, and the pressure builds for higher prices. Let's also consider the geopolitical dimension more deeply. We're living in an increasingly multipolar world. The unipolar moment after the Cold War is over. China is asserting itself economically and militarily. Russia is challenging Western hegemony. The Middle East is in flux. And all of this uncertainty, all of this tension, drives demand for assets that aren't dependent on any single government or currency. Silver, like gold, is a global asset. It's recognized and valued everywhere. It's not subject to sanctions. It can't be frozen in a bank account. It can't be devalued by a central bank decision. In a world where geopolitical risk is rising, where the rules-based international order is being questioned, these characteristics become increasingly valuable. And here's something that's often overlooked. Silver has monetary history. It was used as currency for thousands of years. The US dollar itself was originally defined as a specific weight of silver. The word dollar comes from thaler, a silver coin. This monetary heritage means that silver has a psychological and cultural significance that goes beyond its industrial uses. People instinctively understand that silver is valuable, that it's real money, in a way that they don't understand about other industrial metals. This monetary aspect of silver becomes particularly relevant in times of currency crisis. If confidence in fiat currencies were to erode significantly, and there are scenarios where that could happen, silver would likely see a surge in monetary demand. People would want to hold something tangible, something with intrinsic value, something that can't be printed into oblivion. We saw glimpses of this during the 2008 financial crisis, during the European debt crisis, during the COVID pandemic. Each time there's a crisis of confidence in the financial system, precious metals benefit. Now, I want to bring this back to what's happening right now today as you're watching this. Silver prices are reacting to all of these factors in real time. Every piece of economic data, every central bank announcement, every geopolitical development, they're all feeding into the price action. And what we're seeing is a market that's coiling, that's building energy, that's preparing for a significant move. The question isn't whether silver will move higher. The fundamentals virtually guarantee that it will, given the supply-demand imbalance. The question is when and how fast. And those are the questions that nobody can answer with certainty. But what I can tell you is that the longer the deficit persists, the longer supply remains tight, the more explosive the eventual move is likely to be. Think of it like a spring being compressed. The more you compress it, the more energy you store, and the more forcefully it rebounds when you release it. That's what's happening in the silver market right now. Every month of deficit, every ounce of inventory drawn down, every new industrial application, they're all compressing that spring. And when it releases, when the market finally adjusts to reflect the true supply-demand dynamics, the move could be breathtaking. I've been following precious metals markets for years, and I can tell you that the setup we're seeing right now is rare. It's not every day that you get a market with such clear fundamental imbalances, with such strong demand drivers, with such compelling technical patterns, all aligning at the same time. These opportunities don't come along often, and when they do, the people who recognize them early, who position themselves before the crowd, are the ones who benefit the most. So what does all of this mean for you? It means you need to be paying attention. It means you need to understand that silver isn't just another commodity. It's a strategic asset with unique characteristics and compelling fundamentals. It means you need to consider whether silver has a place in your portfolio, whether as a hedge against inflation, as a speculation on higher prices, or as a long-term store of value. The global events that are driving silver prices right now, the supply deficits, the industrial demand growth, the monetary policy uncertainty, the geopolitical tensions, these aren't going away. If anything, they're intensifying. And as they intensify, as the imbalances become more acute, the pressure on silver prices will continue to build. We're at a critical juncture in the silver market. The decisions you make now, the positions you take now, could have significant implications for your financial future. Because when silver moves, and it will move, it's going to move fast. And the people who are already positioned will be the ones who capture the gains. The people who wait for confirmation, who wait for certainty, will be buying at much higher prices. This is your alert. This is your wake-up call. Silver prices are reacting to global events right now, and those events are creating one of the most compelling investment opportunities in the commodities market. The fundamentals are clear. The technicals are supportive. The timing is favorable. The only question is, what are you going to do about it?